What's happening, Hardscapers? This is episode 126 of the How to Hardscape podcast, where we talked about how you can start and grow your hardscaping business. And today we're joined by Carla Iniguez Policastro. She is the CEO of Cycle CPA, a virtual accounting solution for green industry businesses. And we talk about a wide range of subjects on this episode, from why you should be creating a relationship with an accountant, getting your books in order, and budgeting. Now, we actually have a webinar coming up on November 30th at 11 a.m. Eastern with Cycle CPA and Synced Up. We will be doing a live interview with questions you can submit if you register in regards to end of the year accounting, and then getting into knowing your numbers with Synced Up, a software that will help you with just that. If you register, you can submit a question and you'll be able to tune in live or watch the rerun of the interview, which will not be available elsewhere. Again, be sure to register to get your questions in and to watch this end of the year accounting webinar and knowing your numbers. You can register at howtohardscape.com/webinar or visit the show notes of this episode. Again, that is howtohardscape.com/webinar. For those that register for the webinar and register with a question asked, we'll be giving away 3 merch packages. The merch package is a hat, a shirt, and a sticker from the How to Hardscape merch store. So a hat, a shirt, and a sticker. 3 of those packages will be given away to those that register and register with a question asked at howtohardscape.com/webinar. Now let's get into the episode. Today we're joined by Carla Iniguez Policastro. Carla, I hope I got that right there. I apologize if I don't, but you'll definitely correct me there. And she is the CEO of Cycle CPA, a virtual accounting solution for green industry businesses. Carla, thank you so much for joining me here.
Well, thank you for having me, Michael. And you pronounced that perfectly. Yeah, so as Michael said, my name is Carla, and I'm the CEO of Cycle CPA. And we're doing anything from bookkeeping all the way to CFO services for the green industry. And a little bit about my background is I started off my accounting career at a local accounting firm where we were generalists. So we were helping any business under the sun. We weren't really specializing in any industry there. Kind of your typical, local CPA firm. But then I got to know a lot of the landscapers that worked there and construction workers, contractors, and they all had the similar problems, job costing, the financial side, cash flow, estimating. And so that's really where I got introduced with a lot of these recurring issues and became passionate about helping this industry specifically. And so later on, I worked at one of the largest CPA firms, branched out on my own from there, and I knew that this was the industry that I wanted to focus on because I know that the need was there.
And absolutely, the need is there. I feel like as contractors, we get so caught up in our craft and kind of put the business aspect of running a contracting business aside because we're so caught up in the work that we do and the pride that we take in our work. Which brings me to kind of, as a landscaper, as somebody owning a green industry business comes to you, what is their hesitancy of, I guess, coming to an accountant? Are you seeing that, they've already been in business for 3 to 5 years before they're actually coming to you? Or do you notice that a lot of people are actually, starting their business off right away and coming to you right away? What's kind of that gap in terms of these green industry businesses deciding they need an accountant?
Yeah, no, what I see often is that these business owners are behind on their books. So they're coming to me after the fact. And that, when I ask them, hey, what's going on here? Why do we need to do 12 months of cleanup work or 2 years of cleanup work, right, on their QuickBooks or whichever accounting software they're using? The answer that I get the most is because they haven't had time. Like you said, contractors are very hardworking people. They're very busy. And at the end of the day, they don't want to look at paperwork or even look at an accounting system. There's just no time for it, right? Or, they're just maybe not as informed as for the importance of having your books and accounting up to date. And unfortunately, they come to me at a time where their books are a mess, and they're unable to make those important business decisions, such as Am I able to afford another truck payment? Is this the right time to add on another employee? They're not really getting that those numbers from their books because they're not up to date with that.
And it makes sense, I guess, as a person that owns a business myself and kind of wanting to take pride in my work, that the last thing I think about is typically accounting, bookkeeping. It's kind of put off to the side because I'm not a specialist in that. And it just makes so much sense to start a relationship with an accountant to understand my books a little bit better. So in your opinion, what is the importance of reaching out to an accountant, to having that extra set of eyes on your books? Because I'm sure for some business owners that can be a bit daunting, opening up their books to somebody and kind of letting it all out. And what is that importance in your eyes?
Yeah, so the importance of an accountant or CPA is that they're there to be more of a strategic partner with you. As far as data entry, entering in expenses or sales or categorizing and reconciliation, those are items that really you don't need a degree. Really, there are some people that they're bookkeepers, they're doing these data entry items, but a good accountant and a good CPA, what they'll do is maybe they'll do that work as well, right? But they also provide the business owner with strategic advice and let them know what their numbers are really telling them, right? So they're providing items such as cash flow planification or planning. There's a crazy statistic out there by Intuit that the number one reason why businesses fail is because of poor cash flow. And so your accountant, if they have a cash flow forecast for you, forecasting out the next 6 to 12 months worth of revenues and expenses, letting you know, hey, planning ahead of time, hey, in November, it looks like, cash flow is not looking too good. What can we do now to prepare for that? Or what are some ways we can cut costs, maybe increase a little bit of sales, things of that nature. Another thing that a good accountant does is lets you know the profitability of your company and what it means, and measure some liquidity ratios for you, so leverage ratios for you. And what all of that means is, are you, do you have a lot of loans out on your business? Do we need to scale back on the loans? Is maybe you're purchasing assets such as trucks, trailers, mowers too frequently, and that's going to therefore create a problem in the future. So maybe we should scale back on that for now. Or it looks like your net income or gross profit is low. Is that due to materials expenses being too high, your direct labor being inefficient? And so benchmarking your financials is another thing that a good accountant does. And what that means is taking your profit and loss statement and comparing it to your competitors within the industry that you're in. So I would say that's why a good accountant is really a great tool for any business owner.
Definitely. So having said that, with all the different contractors or landscape or green industry businesses that you've dealt with, what has been, and without having to say any names or businesses, what has been like the biggest eye opener that you've come across where a business owner, you sat down with them, you've gone through their books and you've been able to kind of help them along the way, and you've seen that progress after they've, taken your advice? Do you have a story like that you could share with us?
Yeah, I can actually. It's nice for me to share these stories because I want, all of our clients and our potential clients in the future to have a similar story. That's what our goal and mission is to really help the business owners and, improve their profitability, and also just on a compliance standpoint of any business as well. So yeah, so getting into that, I had this client started out with us, a few years back, and they were having a huge issue with cash flow. And they were very cash poor company. They were the owner. He was always concerned, is he going to make payroll this month? And he didn't want to get into debt either, by taking out loans, because his company was still, small at this point. And so it wasn't worth it. And so he had these things keeping him up at night, right? So we started off with the cash flow forecast, a meeting with him on a monthly basis. So again, that's a great tool that we use. And so what we were able to do, like I mentioned before, is forecast out the next 6 to 12 months worth of sales, direct costs, overhead costs, and then leading to an ending balance, a projected ending balance that would be in his bank accounts, right? And so with this, of course, we saw some months that weren't looking too good. We were able to dissect exactly which areas needed fixing. So the first area was direct labor was very high. And so when we did our ratios on our end, we were able to let him know, like, it's not because you're underbidding or anything like that. It's because your field labor is being less productive or not as efficient, right? So there were two ways we tackled this. The first way was we implemented an incentive plan for his employees. And we implemented a scorecard for them. So every week they were getting measured on a scorecard, budgeted hours versus actual, timeliness, timeliness, whether they were on time to work or not, the quality of their work, and a few other factors that the business owner was measuring. And so he held them accountable for that scorecard every single week. And, we made it a positive thing. Like, these are the points that you can stack up based on your scorecard. And then those points turn into dollars, those dollars turn into a bonus. And so by doing that, we were able to cut back on salaries and wages expenses, right? So that was our first fix. And then we saw that kind of leveled off, and, that was working. But we needed to do something else, because there was not, this company in particular did not invest a lot of money into like large equipment purchases and items like that. So then, we figured that if we invest some money into this equipment, we're able to reduce time out in the field. So then we also did that, and that also reduced those costs. Obviously, we had the monthly payment, but that offset that cost. So it was saving hours, in the field. And so by doing those things, those two items over time, cash flow just became positive for this company. And along with implementing other efficiencies, other pricing strategies too, even targeting a new area that the client didn't work in, a new town as well. So now the client is doing well on cash flow, has increased in revenue. And yeah, that's our success story right there.
That's an awesome success story too. And I love the point system to go along with the bonus system. I haven't heard that yet. It kind of makes it kind of like a gamification of their bonus almost, and gets their employees really bought into that system. Now, coming to, I guess my next question here. Obviously, it's beneficial if you're starting a business to immediately set up that relationship with an accountant. Now, say somebody is starting their business and they're not too sure about it. They're kind of just testing the waters. At what point after that, if they haven't already made a relationship with an accountant, does it become important for them to reach out to an accountant to start to build that relationship? Is it a certain revenue spot? Is it a certain comfortability with the business owner? What is that in your eyes, if they haven't already started to?
Yeah, that's a good question. So I would say that aside from revenue, which I'll get into in a second here, is if the business owner starts falling behind on their bookkeeping. Because what happens then is, then expenses are not entered. Again, they can't make decisions off of pulling up a simple profit and loss. These are my sales, these are my expenses at the minimum, right? If if a business owner is not able to pull up a profit and loss report and 100% rely on it, I would say that that's a major red flag that they need an accountant at that point. And revenue wise, usually I see this happening, and it's different for every company, but starting at 150 per year to 200,000.
Gotcha. Okay, and then you brought up profit and loss statement. I know balance sheet, all these different terms. What are the importances of these different, a balance sheet versus a profit and loss statement? Why you need both? Can you kind of walk us through that really quickly?
Yeah. So a profit and loss statement, it will show your sales, right? It'll show your direct costs or cost of goods sold, which are your materials, your salaries for your field labor, your payroll taxes for field labor, equipment purchases, fuel, and then it'll show your gross profit based on sales minus your cost of goods sold, right? And then below that, your profit and loss statement shows your overhead expenses, which are your advertising and marketing, your telephone, your utilities, your rent. And so that'll show your net income. And this is the profit and loss statement is an important document for measuring the profitability of your company. So as far as expenses and sales, that's what it shows on there. But then and you'll need that for tax purposes too at the end of the year. So it's important that that's always accurate. And unfortunately, I have seen some clients where we onboard them and their sales are overstated, and it's not accurate, and therefore they're paying more taxes on there. So it's important to make sure that profit and loss statement is accurate. And then what your balance sheet shows is your assets within the company. So any bank accounts, checking, savings account that you have, it shows your trucks, your trailers. So for example, if you purchased a trailer this year for $5,000, that is going to be on your balance sheet, not on your profit and loss statement. And the reason being is because your profit and loss statement shows expenses, and your trailer doesn't get expensed for accounting purposes all in 1 year, because you don't use up your trailer in 1 year. Your trailer you're going to hold on to, for the next 5 years, who knows? And so what that is called is depreciation expense. So you chip away at that $10,000 for the next 5 years in an example, let's just say that. And you show a part of that expense on your profit and loss. It comes through as a depreciation expense. And it shows year over year, little by little, it gets transferred over the profit and loss statement. So that's why these big, purchases, they're not on your profit and loss, they're on your balance sheet, because for accounting purposes, you're not using it all up in 1 year. You're using your computer for the next 5 years, let's say. So that expense is going to be shown on your profit and loss. It will be shown on your profit and loss the first year you purchased it, but only part of the expense. So, for example, you purchase your computer, for $5,000 over 5 years, you may do $1,000 each year. That $1,000 is going to be on the profit and loss as depreciation expense. So I digress, but yeah, so you're going to have your assets, your trucks, your trailers, your computer, your office furniture. Then you'll have your liability accounts, which is any loans that you may have for the business, loans on trucks, loans on anything else. And then your equity accounts, which is any money you contribute to the business. For example, you need some operating cash flow, you have to contribute, 5,000 to the business. That's what shows there. Or if you take money out of the business, it shows as owner's distributions. The balance sheet, what it's good for measuring in your business, it's good for measuring your debts, to equity, whether you have too many debts on your business or whether you're meeting the mark, and you benchmark these against industry average, which is what we do for our clients. We make sure that they're not taking on too much debt. We let them know whether they're in line with the industry average or whether they're above that or below. They show the liquidity of your company. So whether you're able to pay those debts as they come due, which is an important metric. Another item is whether you may not be investing enough in machinery and equipment, like that one company I spoke about before. We also measure that too. Like, hey, it looks like your equipment is getting outdated. It's time to reinvest. So those are the items that you will get from your balance sheet versus your profit and loss.
Gotcha. So with that last example with machinery, equipment, it's time to update. Is that as simple as kind of looking at how much that piece of equipment costs to maintain in terms of repairs throughout a season, and deciding, at this point in time, you're paying way more than you would need to then just purchase one, and that maintenance bill goes down, you'll have a new piece of equipment and it'll just cost you that monthly whatever it is that kind of what you should be looking at in terms of making that decision to update a piece of equipment? Or is it multifaceted? Is there so much more to it than just that?
Yes, you can look at it that way. We definitely do with our clients. That's definitely one of the things that we look at. Okay, repairs and maintenance for this one, piece of equipment is outweighing the benefit of it, just add on, like you said, a new piece of equipment. But another metric that we use is asset newness. And so what that calculates is how much you purchase the piece of equipment for, so the cost versus how much it's been used up already. And so that gives us a ratio of, okay, these assets are outdated because this ratio looks like, it's showing us an indication that you've used up a lot of these assets and they're getting outdated. Yep. So that, along with, looking at the repairs and maintenance as well, will give you a good picture.
Awesome. And as we come to a close here, I do want to know, we've talked about so many different topics in terms of accounting, bookkeeping, and what are some things that when a green industry business comes to you, that they're either having, common questions that you come across or common problems, anything that really is consistent or I guess common in terms of these business owners coming to you, asking the same questions or having the same problems in their businesses?
Yeah, so accounting related, a lot of the recurring issues are that they're behind on their books as far as from a compliance standpoint, entering expenses, sales, reconciliation. They're needing cleanup on their QuickBooks accounts. And so we're able to do that. And then also a reoccurring question is, okay, I really don't know whether my business is profitable or not, or should I be charging more, or am I pricing things, correctly? And so with that, we do benchmark the financials to the services that they provide. So for example, if that business owner provides maintenance and design and build, we'll benchmark it for maintenance and design and build. We'll let them know, hey, it looks like, your pricing is spot on, but your direct labor is expenses are high due to, inefficiencies and so on. So that's, a lot of business owners are wanting to benchmark their financials to make sure that they're on track, they're on track for their profitability goals and all of that good stuff. And another thing is that they don't have a good budget in place as well. So we're able to, create a budget for them and, turn that into something that they're able to understand and they're able to make it a goal for their company.
Since you brought up budgeting, what time frame should we be looking at our budgeting or our budgets for the coming year? Are we behind if we're looking at them right now? What do you see typically with this?
We like to start looking at budget planning for the upcoming year in October. We start in October here for the next year, but I wouldn't say if you started in November you would be behind. Really, it just depends. But definitely October, November. Don't wait till the last minute, to kind of get that rolling.
Gotcha. Carla, thank you so much. Where can our audience go to learn more about Cycle CPA? What services do you offer? Can people just sign up for bookkeeping services? Is it a whole package? Talk a little bit about Cycle CPA as we kind of wrap up here.
Yeah, so we have anything from bookkeeping all the way to chief financial officer services or CFO services. So what that entails is we have one bookkeeping package, our essentials, our advanced, and then the CFO package. Within those include, bookkeeping, the simplest one, bookkeeping, reconciliation, quarterly consultations and meetings, all the way to the CFO where we do the budgeting, the cash flow forecasting, and then looking over the accounting staff in-house if that's the case for you. So, but yeah, if you want to learn more about services and pricing that we offer here at Cycle CPA, please visit our website, cyclecpa.com. That's CYCLECPA.com. Another great way to reach me is through my email. It's carlap@cyclecpa.com, or on Facebook. We have a Facebook group with landscapers called Landscaping Accountant, and you can direct message us there as well.
Awesome, Carla. Thank you so much for joining us.
Thank you for having me on. I appreciate it.
Thank you for listening to today's podcast episode. Again, go check out howtohardscape.com/webinar to register for that webinar with Cycle CPA and Synced Up. Again, that is howtohardscape.com/webinar. I'd really love to see you there live and being able to get your questions answered about end of the year accounting. And we look forward to meeting with you next week on the How to Hardscape podcast.